installment of our Stowe and Degon webinar series. This one is going to be about the 2021 tax review and legislative updates. Hi, I'm Marty Croyle, and I'll be the moderator today for today's session. Today's speakers will be my colleagues. Please advance slide. Prasanna Kintambi and Mary Donati. Sorry, Mary.
That's okay.
Before we get into the meat of the thing, let's talk about some of our webinar rules for today. We welcome any and all questions, and we ask that you type them in the Q&A box, which is at the bottom, should be at the bottom of your screen. We will answer them at the end of the remarks by Prasanna and Mary. Secondly, the program is being recorded today. You'll be able to get a copy of it later if you want to watch it again or show it to one of your colleagues. And finally, there'll be a short survey at the end. And please take a moment to answer those questions. And we can also give us feedback on ideas for future programs so that we can keep you all up to date with the things that are important to you. So a little disclaimer. When we scheduled today's program a couple of weeks ago, we had no idea where President Biden's Buildback Better bill would be at this point. And I think anybody who's pays attention to the news knows that all eyes are on the US Senate, particularly Senators Manchin and Sinema, and because they're Democrats who are not excited about the Buildback Better bill as it's currently stated. So today is December 14th, and everything we're going to talk about today is the best information that we have to share with you about the tax part of the Buildback Better bill. I think it's fair to say that there will be changes to the Buildback Better bill when it comes to the tax ramifications. And so we'll keep you up to date with any important changes that we see come down the pike. And finally, next paragraph. This is the topics. This is our agenda. We're going to talk about the legislative update. The infrastructure bill, which was signed by President Biden in mid-November, and the Buildback Better bill, which is now being debated. We'll talk about that. Then the next section, we'll talk about tax planning for businesses, then tax planning for individuals, estates, and gift taxes. And finally, we'll end with the SALT update. This should take us to about 20 of one or quarter of one, at which time we will address all Q&A that you have. So please pay attention, ask any questions you want in the Q&A, and we will answer everything we can. If we happen to go past 1 o'clock and there are more questions to be asked, we can stick around for a few minutes and continue to answer questions. So without further ado, I'm going to introduce you to Prasanna, and he's going to take over the legislative update part of our presentation.
Thanks, everybody, for taking the time to join the webinar today. I'm Prasanna Kintambi. Most of what Mary and I are going to cover today are in general terms, and everyone is different with their own unique tax situations. So before you make any decisions based on what we talk today, it would make sense to have a one-on-one conversation so we can get into it in more detail and make sure that it still makes sense keeping your tax situation in mind. Like Marty said, there's still a certain amount of fluidity with regards to what the final tax rules are going to look like. As some of you may know, the infrastructure bill is official, as it has been passed by both the House and the Senate, but the Buildback Better bill has been only passed by the House at this point of time. To start with, let's talk about what the infrastructure bill is all about. The infrastructure bill plans to spend $1.2 trillion over the next 5 years in boosting up the infrastructure in areas such as transportation, water, broadband, among others. Of the $1.2 trillion, most of it gets split between the states by a formulaic calculation, and around $80 billion will be awarded through competitive bidding. Mass is supposed to get approximately $10 billion. And how are they going to pay for all this? The first thing is the employee retention credit. The employee retention credit, also known as the ERC, was supposed to end at the end of 2021. But now they are ending it at the end of September. In simple terms, it's not going to be available for Q4. For those who don't know what the ERC is, we've had a couple of webinars on this. and a lot of our clients have taken advantage of it. You can see those videos on YouTube. By the way, we do post all our webinars on YouTube, so feel free to subscribe to our channel there. But there have been some updates to the ERC, so I'll talk about it for a few minutes here. There are two sets of rules related to ERC, ERC 2021 and ERC 2020. I'll talk about ERC 2021 first because that's a much larger credit. In terms of the rules, this is a payroll tax credit and will have to be included with your payroll tax return filed every quarter by your payroll service provider. In order to be eligible for ERC 2021, you need to have less than 500 employees, and you need to satisfy one of these two conditions. You should have a mandatory shutdown. Most people didn't have that in 2021. Some people did, but the other condition is that you need to have a 20% drop in sales in a quarter when compared to the corresponding quarter in 2019. Most people, not most people, but a lot of clients did satisfy this condition in 2021. The amount of credit is around $7,000 for every $10,000 paid to an employee during a quarter. So if you paid less than $10,000, the credit is limited to 70% of the amount paid. So it's initially supposed to be for $28,000 per year per employee. So if somebody had 100 employees and they qualified for all the quarters, the amount could have been as high as $2.8 million. So that's a substantial sum of money. Over the past few months, we've had a lot of people who have filed for this and are still waiting on the refunds. Though I've not heard of anyone being denied this credit at this point of time, it will take several months before you see this money as the IRS is really behind. In other words, don't hold your breath for these refunds to it. Another thing to keep in mind is that the IRS issued a notice on this in July, whereby even if you have not received the ERC cash in 2021, you still have to pick up the receivable, the income related to the receivable in 2021, whether you're on accrual basis or whether you're on cash basis. Their logic was that if you're taking the payroll deduction in 2021, you should pick up the income in 2021 itself. So you might end up paying tax on these ERC credits before actually collecting the cash on it because of how long the IRS is taking in order to issue these refunds. Also, we've heard of some people adjusting their payroll tax payments for Q4 in advance since they expected to qualify for the ERC in Q4. Since this has been shut down now, this amount needs to be paid back by the due date of the employment tax returns, which would be January 31st in this case. So that's the rule related to ERC 2021. The ERC 2020 is not as generous as ERC 2021, but it could still add up to a decent number. It's a $5,000 credit per employee for the whole year for every $10,000 paid to an employee. In order to be eligible for this, you either need a mandatory shutdown, which a lot of people did have in 2020, or you need to have a 50% drop in revenues from Q2 to Q4, when compared to Q2 to Q4 of 2019. And another thing to keep in mind, a lot of people did get the PPP loan, and some people take advantage of the research and development credits. You can't really double dip and triple dip on the same wages for all the programs. So you got to there's some amount of calculation and planning involved in order to ensure that you maximize your PPP forgiveness, but at the same time, you get this ERC credit. That's ERC in a nutshell, but now it ends at the end of Q3 of 2021 instead of the end of the year. So that's the first one. The second piece is the cryptocurrency. The infrastructure bill tries to make sure that the investors are reporting their cryptocurrency activity accurately and completely. Everyone who has invested in crypto knows that sometimes it's a pain in the neck to really track the basis of your investments, since some exchanges, especially the non-centralized ones, do not provide a great deal of information with regards to basis. They don't track things on a lot by lot basis, which results in a lot of unreported and underreported income for the IRS. The new law will require the brokers, which is the cryptocurrency exchanges, to issue a 1099B similar to the stock transactions that gets issued now. In other words, cryptocurrency exchanges will now be required to notify the IRS directly of crypto transactions. This comes into play from 2023. So in other words, crypto exchanges have to start tracking these from 2022 onwards. This will in turn create many tax reporting challenges for many investors. For example, some investors who use their own crypto wallet, the information reported to the IRS on the 1099 form will not be accurate, since the exchanges reporting the activity will not really know what the investors paid for the crypto in the first place. Again, the whole crypto world is very fluid, and the Congress is trying to keep pace with it. As soon as this bill was passed, there was a drop in the price of the crypto from $58,000 to $50,000. It's even lower than 50 today. Lots of our clients are invested in crypto, so we do plan to host a crypto-focused webinar at some point in time in the near future. So do keep an eye on our social media pages so that you're aware of them when we do them. Besides the crypto, the infrastructure bill has other miscellaneous provisions like the reinstitution of the Superfund excise tax on certain hazardous chemicals and extensions of highway-related taxes. This does not impact a lot of our clients. We're not going to get into it in too much detail, but if anyone has questions on it, feel free to reach out and we can set up a call to discuss. But it's a little outside the purview of this presentation. That's infrastructure bill for you. Some tax impact, but not a whole lot of changes. But I guess it must be easy to raise $1 trillion these days. Can we go to the next slide? Yeah. The next slide is the Buildback Better. So on November 19th, the Buildback Better was passed by the representatives. The BBBA is now with the Senate. If the Senate passes its own version of the BBBA, which is most likely to be the case, it will return back to the House. The House could vote on the Senate's amendment, or a conference committee could be appointed to reconcile the differences to produce one bill. We don't know how that'll work out, but the House version of the bill is likely to cost around $1.7 trillion, adding to the deficit by $160 billion over the next 10 years. Again, please keep in mind, this bill is not official, but it's important to go through what are some of the provisions within this bill so that if there are certain steps that need to be taken before December 31st, we have the information to do so. Next slide. So the first and the foremost important thing is the state deduction cap. 3 years ago, when the Trump tax reform was passed, they put a $10,000 cap on state taxes and real estate taxes within that itemized deduction. This primarily impacted people in blue states because a lot of the red states are tax-free states. Many people are not able to itemize their deductions or their itemization gets limited because of this $10,000 deduction. The BBBA wants to increase this deduction from $10,000 to $80,000. If this gets passed, then we'll be back to the regime. If people remember a few years ago, we used to always try to pay our Q4 taxes before December 30th, Q4 state taxes before December 31st. So we'll be back to kind of taking a look at that more closely and trying to see if we need to make any state tax estimates before the end of the year. We'll keep people updated on this, where this falls out. So again, we'll send out some sort of a video or a messaging on this when we hear more about it. The next one is the extension of the expanded child tax credit. This is most likely to get passed. If you remember, they had increased the credit from $2,000 to $3,000 for kids age 6 to 17 and $3,600 for kids under 6. Some of you might have already received the advance on this credit in 2021. It's important to keep an accurate record of what you've received so that it'll be easier when we go to prepare your tax returns. The next one is the expansion of the 3.8% net investment income tax. This is also called the Obamacare tax. What this is primarily trying to do is close the S-Corp tax loophole. And this has been around for years. If an S corp made $100,000, and if the owner takes out, say, $40,000 in salary, that $60,000 that's remaining as a profit is neither subject to self-employment tax or this Obamacare tax. In a partnership type situation, the same $100,000 would be subject to self-employment tax, whether you take salary or not. This loophole has existed forever. Our Congress is finally looking to close this loophole and expand the net investment income tax to the remaining $60,000 in my example. So there'll be an additional 3.8% tax to pay on the profits of the S corp if this gets passed. The next one is the Section 1202 qualified small business stock. This doesn't happen all the time, but some people do take the benefit of this. Section 1202 was enacted in 1993 to encourage investments in small businesses. It allows individuals to avoid paying taxes on up to 100% of their taxable gain recognized on the sale of this qualified small business stock. You obviously have to fulfill certain conditions, which include holding this, one of them which includes holding the stock for at least 5 years. This exclusion is available for up to like $10 million or 10 times the adjusted basis of the stock. Congress would like to allow this exclusion only up to an adjusted gross income of $400,000. So it's another indirect increase in taxes. I don't know if this will get passed or not, but this can be a pretty sensitive topic within the House, within Congress. The next slide. Another thing to keep in mind is this 3% and 5% surcharge on non-grantor trusts. We have a lot of clients who have set up non-grantor trusts, which pays its own taxes. You might have heard of individual taxpayers being subject to 5% surcharge on adjusted gross income in excess of $10 million, and additional 3% surcharge on adjusted gross income in excess of $25 million. However, they've kept the threshold much, much lower for estates and trusts. It's only going to be $200,000 and $500,000 of income. So a lot of trusts might end up having to pay the surcharge. The best way to kind of avoid this surcharge is to consider distributing income earned by the trust to the beneficiaries if they fall within this trust threshold. So the income gets picked up at the individual level rather than at the trust level. The good thing is that the trust typically have 65 days to distribute after year end. So distributions need to be paid by March 6th and not by December 31st. So if they change the rules with regards to this from 2021 onwards, which I don't think will happen, but if they do, then we would still have some time to kind of make distributions to the beneficiaries. Again, we are keeping a close eye on this, but we might not be as pressed for time here. The next one is the GILTI tax. This tax was initiated as a part of the Trump tax reform. Even though Trump reduced the tax rate for corporations, he broadened the base. If you remember a few years ago, there was a huge hue and cry about companies like Apple, which were keeping billions of dollars abroad without repatriating it to the US in order to avoid taxes. But this rule ended up impacting a lot of clients who have even smaller businesses which have foreign subsidiaries or individuals who own foreign corporations or who have control over foreign corporations. These entities needed to end up paying the GILTI tax. What it essentially does is it doesn't wait for the money to be repatriated back to the US. You pay the tax as the income is earned by these foreign corporations. The GILTI tax rate approximately works out to around 10.5%. Even if it's not repatriated back, the BBBA would increase this tax rate from 10.5% to 15%. So another increase there. The other thing to keep in mind is the Congress is trying to close the loophole with regards to wash sale rules related to cryptos. What is a wash sale? These types of transactions in which somebody sells a security in order to realize a loss only to purchase like an identical security shortly thereafter. So what that means is, let's say I bought a stock of Tesla for $500 on December 1st. On December 31st, the stock is worth, let's say, $300. And you want to take this $200 loss. People used to kind of sell that on December 31st and buy it back on January 1st. So in order to close that loophole, Congress had come up with the wash sale rules, whereby they said that you have to stay out of this position for more than 30 days. So you'd have to kind of stay out of the Tesla stock till January 31st in order to take advantage of that $200 loss. This wash sale rule never existed for cryptocurrencies because cryptocurrencies are more treated like properties and not like stock. So Congress is trying to close this loophole. So philosophically, before the end of the year, and Mary is going to talk about it a little bit more, but you could, if you have certain positions that you're holding in losses, you could philosophically sell those positions and buy it right back, especially since crypto hasn't been doing great this month. The next one that they're looking at is closing the backdoor Roth conversion. Again, this is a strategy used by a lot of our high net worth individual clients. Normally, many of the high income individuals cannot contribute directly into a Roth IRA account because their income is too high. So the way you go about doing it is that you contribute money into a non-deductible traditional IRA account, and then you convert it into a Roth IRA and usually pay low taxes or no taxes on the conversion. If this gets passed, 2021 might be the last year that individuals are going to be able to do this backdoor Roth. Again, we're keeping an eye on it. We'll keep you guys posted. The rest of the stuff in this slide doesn't impact us that much. The 15% minimum tax on certain corps, I call it the Amazon tax. It is to ensure that large corporations are not avoiding taxation through research and development vehicles and other credit vehicles. And then they're going to institute a 1% surcharge on corporate stock buybacks. And that'll happen for public companies after December 31st. Can we go to the next slide? As one can imagine, there are a lot of provisions with regards to green energy, and it can be a separate webinar in itself. But some of the major provisions that are extending the credit for the installation of the residential solar panels. Right now, we have a 26% credit on that, and they want to bring it back to 30% till the end of 2031. And then the credits would again phase down from 30% to 26% till 2033 and 22% after that. They would bump the electric vehicle tax credit to $8,500. That should boost up the Tesla prices even more, or Tesla stock prices even more. Then we talked about this briefly. They're looking to initiate this high income surcharge with regards to people who earn more than $10 million and $25 million during the year. This might not impact most people on a year-to-year basis, but there might be some years that people have like they're selling their business or some large transaction which might create huge income. So we'd have to look at that more closely to see how to structure these earn-outs and the escrows and stuff. Obviously, that has to be looked at on a case-by-case basis to kind of manage that better. The rest of the stuff is like expanding the premium earned income credit. The premium credit doesn't impact a lot of our clients. With that, I'll hand it over to Mary to talk about some of the strategies that one should think about before the end of the year.
Hello, everyone. We're going to start with the corporate tax planning. And the great news is that the corporate tax rate is remaining at 21%. And the current version of the Buildback Better bill does not seem to have a rate increase. As we have mentioned before, unfortunately, it still has not passed the Senate. So this is subject to change. And hopefully there will not be any changes. But if there are, we will let everyone know as soon as possible. Depreciation rules significantly have not changed. 100% bonus depreciation is still available for the 2021 year and the 2022 year. Section 179 deduction is still available. In the 2021 year, it's limited to 1,050,000, and it will increase to 1,080,000 in the 2022 year. We want to remind everyone out there that the cash method of accounting is available method of accounting for tax purposes. And a lot of business find this to be an easier method for reporting income. And it's available for most businesses, including corporations and partnerships with income of $26 million or less. It's an average type of computation over the last 3 years. And as the cash methods indicates, is exactly what it sounds like. You report an income based on the cash that you took in and the expenses you paid out. Now, if you currently are on the accrual method for reporting income, talk to us, because there is an election that can be made to convert a taxpayer from the accrual method of accounting to the cash method of accounting. And if we could switch on over to the next slide. The next wonderful item out there is the de minimis safe harbor election. This is an official election on the tax return, and it's available for those taxpayers who have a policy to do this. And what it does is it states that if you brought an individual item of $2,500 or less, or have an invoice of $2,500 or less, instead of capitalizing it as a fixed asset, and then having to depreciate it or take 179 to get the deduction on your tax return, you're going to make this election and you're going to expense it right away into whatever type of category it belongs in, whether it's repairs and maintenance or office expense. An example would be at the end of the year, towards the end of the year, you decide that you need to buy 10 laptop computers for your office. They're $1,000 each. So you have a bill for $10,000. Instead of capitalizing this $10,000 bill, you're going to expense it right away to office expense and get that deduction during the current year. Now, slow moving inventory, as we all know, COVID has had a major impact on the supply chain. And what has taken place is it has slowed down inventory. So if you're sitting with inventory available for sale, and it is not moving, speak to us, as you may be able to take a tax deduction for that available for sale inventory this year. Another great idea for those individuals who have recently purchased or constructed residential or commercial property is a cost segregation study. What a cost segregation study does, it is a study that will analyze the personal property inside that building that has recently been purchased, and that personal property is available to be depreciated over a lower lifespan. Now, usually you do a cost segregation study after a building is purchased or has finally been constructed. There is a method to go back in time and do a post cost segregation study on buildings placed in service in a past year. So what you're essentially doing is what essentially is happening is most residential buildings are being depreciated over 27.5 years, and commercial buildings are being depreciated over 39 years. And this cost segregation study will take out those assets that can be depreciated over 3, 5, 7, 10, and 15 years, giving you a greater benefit tax-wise now instead of later. Now, the employee retention credit we did talk about earlier, and that is going away on September 30th, 2021. And if we can move on over to the next slide, we are now going to go into the individual and estate gift tax planning. So just like the corporate income tax rate, the individual highest rate will remain at 37%, and the current version of the Buildback Better bill does not have a rate increase to this. Now, as you know, this is subject to change. We don't know what the Senate will do. And if there is changes to this rate, we will let everyone know as soon as possible. The same thing applies to the long-term capital gain rates. There has been no change to these rates. The bill has no changes currently for these rates, but they are subject to change in the Senate. Now, the qualified business income deduction is still available. And what the qualified business income deduction is a deduction that is available for pass-through entities like S corporations, partnerships, proprietorships, and some trusts that meet certain qualifications that they're able to take an above the line deduction of approximately 20% of their income that passes through from these businesses. We can move on over to the next tax loss harvesting. This is a great idea to reduce realized gains during the year. And if you have a lot of realized gains that have taken place in the 2021 year, you should be reviewing your portfolio or speaking to your investment advisor to see if you're sitting with any losses that can offset these realized gains. Now, in terms of the cryptocurrency people out there who have invested in these transactions, there are a few things we want to make sure you are aware of. The first one is cryptocurrency does have to be reported if you have a sale. And the IRS is really looking into this. They have gone back all the way to people in 2013 and issuing notices if they think you had a sale or they believe that you may have had a sale, you could be receiving a notice. In addition to this, some people just are not aware that on the tax return, you are saying yes or no to whether you're involved in a cryptocurrency transaction. So if you are involved in cryptocurrencies, please make sure we do know about them. And then as Prasanna did indicate, for cryptocurrencies, wash sales may be going, wash sale rules may be applying to the 2022 tax year. So if you are sitting with losses for cryptocurrency, this could be the last year to take it. And you may want to speak to us about selling these currencies this year and then quickly rebuying your stake in those investments so you can take that loss in the 2021 year. The next thing is when you're reviewing your investment portfolio, you may be sitting with a lot of built-in gains in your portfolio. And if your adjusted gross income has been reduced in the 2021 year, you may want to take those gains this year, especially if these gains can be taxed at a 0% rate or a 15% tax rate. So consider speaking to us to see where your AGI is and what type of rate you would be subject to if you did take those gains that you're sitting with it in the 2021 tax year. Another thing, as Prasanna indicated, is if you're able to itemize, the state taxes currently are capped at $10,000. However, the Buildback Better bill could increase that to $80,000. And if it does, we will let everyone know before the end of the year so that if you have state tax payments that can be taken, you can take them before December 31st. Now, COVID has caused a lot of people to remote work from home. And this is it's a bit of a complex tax situation because working from home means that generally you will be taxed on those wages in whatever state that you are working from. However, and there's always a however, isn't there, that there are a few states, 7 of them, where if you are working from home, you're actually going to be taxed in the state that your company is located in. And one of those is this wonderful state of Massachusetts. So if your company is located in the state of Massachusetts and you're sitting working at home in the state of New Hampshire, those wages that you earned will be subject to the state tax in Massachusetts. So if you are remotely working from home, we suggest that you talk to us so you are on board of what type of tax situation statewide you could be having. Now, we also want to let people know that if you permanently are going to be working from home in the future and things won't be changing and you could move elsewhere, you may want to consider moving to a tax-friendly state like Florida, Texas, where there is no state tax. So those are things to consider and talk to us about. We can move on over to the next page. This is one of those things that I really have a pet peeve about when I'm preparing people's tax returns. And I look at their W-2 and I see they fail to maximize their retirement contributions, because this is such an easy thing to do, especially if you have the available funds. So just to recap and let everyone know, the maximum 401k contribution for the 2021 year is $19,500. If you're over 50, you can contribute another $6,500. If you have a simple IRA plan, the maximum contribution is $13,000 with a catch-up plan of $3,000. And if unfortunately you don't have either of those plans with your work, and you still can contribute to a regular IRA or a Roth plan at a maximum contribution of $6,000 and a catch-up if you're over 50 of $1,000. The same thing goes with trying to maximize those flexible spending accounts if you have one. The maximum contribution to a flexible spending account is $2,750 for the 2021 tax year. And the maximum contribution to a dependent care spending account, if you have one, is $10,500. The maximum contribution to your HSA account, if you have one, is $3,600 with a catch-up available of $1,000. For those of you out there who have a donor advisor fund or considering a donor, establishing a donor advisor fund, what a donor advisor fund is, a charitable gifting account, which is usually established at places like Fidelity or T. Rowe Price. And what it allows you to do is contribute cash, appreciated property, investments into this fund, and you get an immediate deduction for those contributions. And then you can think about where you would like and recommend to the investment advisor where you would like those contributions donated to at a future date. The other idea for contributions that are out there, if you're thinking of making some charitable contributions, is to use your qualified charitable distributions, which are available for those of us who have an individual retirement account. And especially a wonderful tool if you have to take your required minimum distribution and you already know, hey, I want to contribute, $10,000 to XYZ, to an XYZ charity, and my required minimum distribution for the year is $10,000. You're going to call up your investment advisor, your fund advisor, and say, hey, I'd like to make a qualified charitable distribution to this organization. And what this does, it allows that required minimum distribution to not be taxable to you on your tax return. It avoids that tax consequences of having that required minimum distribution. Roth conversions, as we talked about earlier, may go away for the 2021 year. Not only that, the Buildback Better bill also has a provision that says that, you can't take your IRA and convert it to a Roth if, you meet certain AGI limitations. So not only will you not be able to do a backdoor Roth contribution in 2021, if this Buildback Better bill goes through as written, you may not be able to convert an IRA to a Roth if you meet certain AGI limitations. Now, these are all subject to change, and we'll see what happens when it goes through the Senate. If we can move on to the next page. Estate tax planning. The great thing about estate tax planning is everyone should be keeping in the back of their mind, every so often you should be looking at your will. And the reason you should be looking at your will, you may have made your will, 5 years ago, and you lived in the state of Massachusetts, and now you live in the state of Florida. Well, the state of Massachusetts and the state of Florida have two different estate tax filing requirements. And so you should talk to your attorney about the differences in the state tax law for those two states. You also may have a new spouse, you obtained a spouse, you have more children, additional grandchildren that you may want to incorporate into your will. The same thing goes with your executor. 5 years ago, you put your son as your executor, and now you want to make your daughter. So these are things you should be looking at every so often. Besides that, the exclusion amount for 2021 is 11.7. It will go up to a little bit over 12 million in the 2021-22 year. Gift tax exclusion for the 21 year is 15,000 and the 22 year is 16,000. You really should be filing gift tax returns if you have given anyone above those amounts, any one individual. You don't want, things to happen and receive notices that, gifts have taken place. Another great idea is to super fund, if you have the money available, 529 plan. And what a super funding does, it allows you, it's a mechanism that allows you to, in the current year, put $75,000 into a 529 plan. And that $75,000 will be averaged over 5 tax returns for $15,000 each year. And even if you can't do up to $75,000 into a 529 plan, I highly recommend, if you have children or grandchildren, consider putting any amount of money into a 529 plan, because it does make a difference when your child or grandchild does go to college. And now I'll turn it back over to Prasanna.
I gotta unmute. Can we go to the next slide? Yeah, so we've talked about this $10,000 limitation at the individual level a few times. So what some of the blues, because mostly people in blue states are impacted, what some of the states have been doing in order to circumvent this rule is coming up with an entity level tax. So what that really means is that, let's say a business makes $1 million, it's a flow through business, and it makes $1 million in profit. And that $1 million previously used to flow through to the individuals, and the individual would pay $50,000 mass tax at the individual level. So what they're trying to do is trying to come up with this entity level tax, whereby they collect this $50,000 at the entity level and give you a state tax deduction for these taxes that were paid. So the income that gets allocated to you at the federal level, instead of $1 million, is $950,000 now. So again, the IRS or Massachusetts has instituted this pass-through entity tax similar to it. And instead of giving you a dollar for dollar credit for the tax that gets paid at the entity level, they're giving you a 90% credit. So essentially they want an extra 0.5% tax for the benefit that they are giving you at the federal level. We've done the calculation for this. For every $1 million in income, the benefit in paying the tax at the entity level could vary from like $10,000 to $15,000. Again, everybody's individual tax rates is different. Personal scenarios are different. So you got to look at it on a entity by entity basis. But that's kind of the main idea behind instituting this pass-through entity tax. Mass did come up with some sort of a guidance last week, whereby they kind of issued the draft form for it, and also showed people how to kind of make this payment. For cash basis taxpayers, if you want to take advantage of this payment needs to be made before the end of the year. But for an accrual basis taxpayer, all we have to do is accrue it in order to get the deduction. Again, if you guys are a cash basis taxpayer, we might be looking at it already, but feel free to give us a call and we can kind of talk through if it makes sense for you to make any payment before December 31st or not. The other thing with the whole COVID thing, obviously people are working from home, people are working from different locations. businesses need to be aware of where their employees are working from. It could lead to some unintended consequences whereby you might have a employee who's working, let's say, from France, and now you have a nexus in France because you have you have a senior level executive working there from out of a different country. So it's important to understand where your employees are working for. So and in order to keep the nexus analysis in mind and make sure that you're doing your withholdings in the right places. That's all I have for this. Marty, I'll give it back to you.
Thanks, Prasanna and Mary. Perfect renditions of this BBB as it stands right now. I'm going to remind people down in the Q&A if they would like to add a question for us. And we have some already, but if you'd like to get them in, if you could type those in now, that'd be great. So the first one is, are there any changes in international taxes as related to the BBBA?
The only one that I have read so far is the one that I talked about a little earlier, which is regards to the GILTI tax, which is if your business has a foreign subsidiary, or if an individual has a majority holding in a foreign corporation, you might be paying some additional taxes on this foreign entity's earnings, even if you haven't repatriated the money back to the US.
Okay, thanks, Prasanna. I own a S corporation, and I heard you talk about this 3.8% net investment tax that could be passed by the BBB. Do you think if it's passed that would impact the 2021 return? Or would it start in 2022?
So historically, I believe it'll impact 2022, and I'll explain why. Historically, when they have increased tax rates, they've never done it retroactively. It's always been prospectively because it's just a bad optics when you try to kind of go back and change tax rates. The deductions could work a little differently. For example, the state tax deduction could get bumped up in 21. Again, we don't know for sure. We're keeping an eye on it, but most likely most changes will happen as of 2022.
Okay. If I've heard anything today, it's that there's a lot of uncertainty as to whether or not the BBB will pass and what form it will pass and whether or not we're going to know any of this by the end of the year. How hard is this for us to decide what to do for tax planning along with your help with all of this uncertainty?
Yeah, it's always challenging in order to kind of keep in. We're always trying to kind of stay in front of it and trying to think of different clients and how they will be impacted by different rule changes and stuff. But the lack of certainty with regards to it always makes it challenging. That's why we try to do these webinars, tax planning is an important aspect of it. It's important to look at everything before the end of the year. If you guys haven't had tax planning done before the end of the year, it's always a good idea to take a look at that. That's all you can really do. I mean, sometimes some of these things might get past December 30th, and we might not have enough opportunity to react to it if anything needs to be done before the end of the year. But again, looking at it up front, at least you kind of know some of the action steps you might be able to take.
Thank you. When I had a PPP loan forgiven, I remember it was tax-free. You mentioned the ERC credit. Have you heard anything saying that that could become a tax-free event?
I haven't. I think last year at this point, I think if I go back and look at my notes from last year's webinar, I think we weren't sure at that point if PPP would be taxable or not taxable, or if or we weren't sure how like the states would react to it. So so the same thing goes for the ERC. At this point, it's the way the rules are written, it's taxable. People haven't been complaining about ERC as much as they complained about PPP back then. Yeah. So I feel like it's going to continue to remain taxable, but who knows what will happen.
Got it. When will the proposed increase in state and local tax deductions take place? I assume that, is that 21 or 22? I assume they're talking about the SALT increase if it's passed.
Yeah, Mary, do you wanna, or I can answer, doesn't matter, but I think it's gonna be 2022, but again, like deductions can be done retroactively, so it could end up being 2021.
So if I prepaid my taxes in 21, expecting it to go to 80,000 and it doesn't happen until 2022, did I do that prematurely and I'm not gonna get that benefit?
Well, you will have the opportunity in 2022 to adjust for it, but yeah, I think that's why it's important to keep an eye on it. But and I wouldn't write the check yet. I would keep an eye on it and keep the check ready. Maybe keep a postmarked envelope ready so that you have the ability to send the check if it does pass through.
Okay, next question. Can you explain the tax math if my company received a $20,000 payroll tax credit?
Are we talking about the employee retention credit here?
I would guess so. This person doesn't say that, but I assume that's what that is.
Okay, so I mean, if that $20,000 is, so let's say you paid $100,000 in payroll and you got $20,000 in credit, you have a net payroll expense of $80,000. So whatever your tax rate is, that's what you'll end up paying, or that's what your benefit will be on that $80,000.
And you'll someday get that $20,000
and someday you'll
check
get
back from the IRS
Yeah.
to offset that additional that
Yeah.
lower payroll tax deduction.
Yeah, it kind of sounds ridiculous to me that the IRS is taking forever to send those checks in, but they are specific that they want you to pick up the income even if you haven't received that credit yet.
I would agree with you there. Do you recommend high income earners do a Roth or pre-tax to max out 401ks if they are in their mid 50s or older?
I mean, I think everybody should be maxing out their 401k. With regards to Roth conversion, it depends really from person to person. It depends on the age of the person. It depends upon, like, again, if somebody is 80 years old, it doesn't make sense to do a Roth conversion because you're going to pay taxes on it, especially if you are in the high tax bracket. If somebody is like 40s or 50 years old, sorry about that. If somebody is 40 or 50 years old, you still have a lot of time in hand. So I would think that it still makes sense to do the Roth conversion, but at the same time, you got to look at what tax bracket you are in. If you're going to be in the maximum tax bracket, let's say you converted $1 million, you're going to pay $400,000 tax on it. And if you have that extra cash to pay, then that's fine. But if you're going to take $400,000 out of your retirement account to pay for it, doesn't make a whole lot of sense. So it, again, depends from person to person, situation to situation, and the amount to amount, I guess.
Good answer to a hard question. Does the QBI, the qualified business deduction of 20%, does that apply to LLCs?
The deduction applies to, it does apply to LLCs depending upon what business they are in. The qualified business deduction gets limited for people who are in the accounting profession or people who are in the legal profession or like management consulting and stuff. But the entity type itself doesn't matter. It depends on what you're doing within that entity.
Got it. Have there been any changes to the carried interest treatment, or has it been left largely unchanged?
To be honest, I have not been on top of the Section 1061 rules. I believe that the carried interest rule still remains the same in terms of if you are actively involved in a fund and you hold the stock for less than 3 years, then it's more a short-term capital gain than a long-term capital gain.
Okay.
We can take a look at that and we'll send a note on it.
Okay, that was sent to us by an anonymous attendee, so I don't know how we can respond to them, but maybe they can send another item in the Q&A just to tell us who asked that question so we can get back to them. What is the definition of slow-moving inventory according to the feds?
Mary, you want to take that one since you kind of talked about it, or I can do it. So the slow moving inventory, I think every business should be looking at their slow moving inventory list, which is essentially things that have been sitting in your list for maybe a year or so and haven't been sold, or is not likely to be sold, or it's not likely to be sold at the price that you bought it for. So I think a year is probably a good guide if something has been sitting in your inventory list for a year. I think it's probably a slow moving inventory. And I think, again, it's about determining if it should sit in the reserve or you should kind of take it out of your inventory and take the tax deduction for it. That depends on what you think is the probability that that inventory will get sold.
And if you keep that slow-moving inventory in an inventory reserve for obsolescence or whatever, you don't get that tax deduction, correct?
Yes, you don't.
Okay. Next question. You mentioned a tax credit for EVs. Is that income limited?
Last time around, there was no income limitation on electric vehicles. So I'm going to presume here, I don't know the answer for sure. I'm going to presume here that there is no limitation even now with regards to it. There is going to be a limitation with regards to the value of the vehicle. If it's the only thing I read was if the vehicle was more than $100,000, the credit would get limited. But other than that, the income itself wouldn't be a limiting factor.
Okay. We now know who asked the question about carried interest, so we can get back to
Oh,
the
okay.
person.
Marcus, I'll take a look and get back to you.
And one last question. You talked about the mass pass-through entity tax. Would that include a capital gain if I sold my business in 2021?
I think it will. If you have capital gain that exceed capital losses, in other words, you have a net capital gain, then it should be included in your pass-through entity tax calculation.
So if someone has a sale of a business, they definitely should be looking at this, correct?
Oh yeah, totally.
Okay.
And if they are on cash basis, they should pay the tax before the end of the year.
And if they're on the accrual basis, when does that payment have to be made?
For an accrual basis taxpayer, you have to make the payment before the return is filed. Actually, I should say that separately. If you're going to extend your tax return and your return is due March 15th, you should make that payment before March 15th.
Okay, by the extension date.
By the extension date, yes.
Okay. Well, we've been doing these webinars for a while now, and we've never ended at 1 o'clock before, right on the nose, but I think we have today. So I want to thank Prasanna and Mary for doing such a great job, and for everyone for attending. And we had a lot of good questions today. So feel free to contact anyone at Stone Degon with any questions you have. I'm sure you'll all pay attention to the news and what's going on in the Senate particularly. And we will keep you abreast of any important tax changes as we see them come down the pipe. So thank you all for attending today, and we look forward to seeing what the next event we have.
Okay. Bye, guys. Thank you.
Bye.
Thank you.